Hey everyone, and welcome to another episode of the Real Hickory Podcast. I'm Mike Kerley, your host. Thank you so much for listening. And if you're enjoying this content, please like and subscribe so we can get more love from the algorithms and get some more listeners and viewers. Please remember we have a Facebook page, a YouTube channel, and we can also be found on Apple Podcasts and also Spotify and anywhere that you would consume a podcast. Today, we'll be chatting with Tim Kerley with Atlantic Bay Mortgage to discuss the current lending environment. We generally talk to Tim once a year to get an update on lending and to get advice on how to finance the purchase of your home. Tim's not only a great lender, but a personal friend. So without further delay, welcome to the show, Tim. On today.
Thank you, Mike. It's good to be here, and it's good to be back again, and I appreciate you having me on.
Yeah, I think you're actually the first three-time person that I've had on the show. So hopefully people don't get bored with it. But I think it's really important content that we got to get out there for people, because lending is a really super important part of the process. And a lot of things I feel like in the process of buying and selling homes kind of get messed up if the lending part isn't done properly. So again, appreciate you being on here and maybe helping us try and kind of get everything going and try and get some good information out there to people. So Tim, for those that don't know you, tell us a little bit about yourself and how long you've been in the lending industry.
Well, I grew up over in Alexander County, so not far from here. And so I've been in this area pretty much, general Western North Carolina area, pretty much my whole life. Went to Appalachian State, graduate degree from Gardner-Webb. So, I've spent some time in Burke County, Iredell County, Catawba County, Gaston County, all around this area, and started my career many years ago with the old Wachovia Bank. And so I've been doing some type of lending for, I don't know, I guess that would be 30 some years now. And even back in the 90s was doing some form of residential lending, but I've been full-time as far as residential mortgages since 2003. So this will be my 18th year. So I've been around a while and learned a lot, but a lot of things are still changing in this business, as you can imagine.
That's for sure. It seems like every day there's something new that's coming out that's kind of affecting things. And again, that's why I think it's really important to have, talks like this so that we can kind of make sure everybody kind of has all the information they need to make a good decision. So Right now, what do you see as the biggest challenge for people, getting the process started with, borrowing money to buy a home?
Well, I think especially when you look at first-time home buyers, one of the main obstacles with those folks, if you're trying to buy your first home, is the money that you need up front. So if you're using let's say you're using a conventional program and maybe you need a 3% down payment, in a normal market environment, you might have a situation where maybe the seller could cover some of your closing costs. A lot of people don't understand that you've got to have a down payment and then you've got some closing costs there. The lender's got their fees and the attorney and the appraisal, and you've got to have homeowners insurance and all this stuff. So, if you, in a normal environment, if you're doing a 3% down payment on, we'll just use easy numbers, maybe 200,000, that's $6,000. But in the environment today, which is heavily or much more favorable to sellers, I think you would agree with that. It's hard to get the sellers to pay closing costs because they have so many offers, they have so much competition. So now if you're a first-time home buyer, not only do you need your $6,000 upfront down payment, now you've got to have another $5,000-$6,000 for your closing costs. So that kind of doubles your upfront money needed. And that seems to be, to me, the main challenge for first timers, is kind of crossing that hurdle of the upfront cash needed.
So are there any solutions out there for people that maybe they don't know about, or is it just save more money?
There are some, there are a couple of programs out there where you can do 100% financing. And you've got some down payment assistance programs as well, where they will provide money that you can use for the down payment and or closing costs. So there are some solutions out there, but those do tend to be a little bit more narrower as far as the qualifications go. So, which I can kind of give you a rundown of those things. I don't know if you want to do that at this point.
Yeah, sure. I think that's probably a good segue to go into that. So
yeah, so I get a lot of questions about first-time home buyer programs, and so there are some ways that you can get there as far as 100% financing. There's a program that's offered through USDA. I don't want to go deep into the specifics on these, where you don't have to have a down payment on that program. And then, of course, if you're an eligible veteran, you can use a VA loan and get 100% financing. And then, like I was saying, there are some down payment assistance programs that can help you kind of bridge that gap there as well. So there are programs available. I guess the thing I would say is, when you think about first-time homebuyer programs, the main benefit of those programs is generally going to be some kind of down payment assistance, or some way to try to get you into the home without so much cash up front. It's not necessarily a more lenient program as far as credit goes and some of the underwriting. In many ways, it's maybe a little bit tighter. If you think about it, if you're doing 100% financing, a lot of the programs are going to be a little bit stricter on the underwriting guidelines as far as the credit goes and the debt to income ratio and that sort of thing, if that makes sense.
Sure. No, it totally does. And so for no down payment loans, that's kind of what people's options would be. And then for like lower down payment loans, what other options we have? FHA, and then even some conventional, right?
Correct. And by the way, so some of the programs I'm talking about, you do have to be a first-time home buyer to be eligible for them, but some of them you don't.
Okay.
Some of them you just have to meet the income limit. So they all have income caps. So they're basically targeted for a certain income segment, and some of the income caps are just based on the person who is applying for the loan, the borrower. Some of them are based on your total household income.
Okay.
So that's something like the USDA, for instance. So that's something you want to keep in mind if you've got a situation where maybe you have adult children living at home who are working, they're not full-time students, then their income would be included in that calculation, not to help you qualify for the loan, but to make sure that your household income fits under the USDA cap.
And sometimes that could be too high, right? Like, it's not just a matter
correct.
of not being like high enough. It could put you over the limit.
Correct.
Okay.
Yeah, that's right. That's the interesting thing, is on USDA in particular, they look at income in two different ways. First of all, they look at the income that is needed to qualify for the loan. Do you have enough income with the borrowers on the application to be able to make this payment plus make all your other payments? And the second way they look at it is the household income. Does your household make too much money? Is your household income under the cap of where it needs to be eligible for their program?
Okay.
But I know you were asking about on conventional loans, FHA, for instance. So on a conventional loan, Fannie, and for our audience, I'll kind of give you this information. On a conventional loan, you have two different investors on that. You've got Fannie Mae and Freddie Mac. You've heard of those two kind of quasi-government agencies. So Fannie Mae has a first-time homebuyer program where you can do as little as a 3% down payment. One of the borrowers does have to be a first-time home buyer, but there's no income limit to that program. So that one's pretty wide open, and it follows pretty much the normal underwriting guidelines on that. Both Fannie Mae and Freddie Mac do have income-based programs as well, where you can do the 3% down payment if you fall into their income range. The thing that is good on those two programs as well is you get subsidized mortgage insurance premiums. So your mortgage insurance would be a little bit less there. And then you've got FHA, you mentioned that, that one, no income limit. And you don't have to be a first-time home buyer. It's a 3.5% down payment straight across the board on that one. It's just that FHA is not used as much as the other programs, because in some cases it does turn out to be a little bit more expensive depending on your credit.
Okay.
Let me also say one more thing too here. When we talk about first-time home buyers, a first-time home buyer is defined as someone who hasn't owned a home in the last 3 years. So that's important there as well. It doesn't mean you've never bought a home before. It just means you have not owned a home in the last 3 years. If you haven't, then you could be considered a first-time home buyer on the programs where you have to be a first-time home buyer.
Okay. Well, that's good to know because I would not have thought that. Okay.
Yep.
What's your suggestion? Like when somebody, let's say somebody's just getting into the game and thinking about buying a house, and they talk to one of our agents, and our agents say, yeah, have you talked to a lender yet? And they say no. So we then would say, all right, well, we've got a couple people we could maybe hook you up with. Here's Tim's phone number. Why don't you talk to Tim and maybe see what you can do to get pre-qualified? What's involved in that process for people when they decide that they're ready to kind of take that leap and get pre-qualified for a loan?
Yeah, for me, I've got a short little questionnaire that I will usually send you a link to, and you can fill that out. It's out on my website, but it gives me some basic information to get started with. It gives me permission to be able to pull the credit. And so that kind of starts me off, and then I can ask questions from there. So one thing I would say is, and you're right on. I mean, when you start looking for a home, I would say for sure these days, your first step is going to be to talk with the lender. You want to make sure that you have your financing lined up. So the other thing I would say too is that you want to make sure to find a lender that will do actual upfront underwriting, because when you start talking about, you can throw around the terms, pre-qualification or conditional approval is one that we use. Like pre-qualification means different things depending on which lender you're talking with. And it might mean, like for us, a pre-qualification means you've submitted your application. We've looked at your credit. We have run your application through the automated underwriting program engine for whatever program you're trying to be approved for. And then, it'll give us a pre-qualification letter. But I also recommend, and back to what I was saying is, you want to find a lender that will do upfront underwriting. And what that means is you want a lender that's going to go ahead and collect your documents, your pay stubs, your W-2s, bank statements, maybe your tax returns, and get that in front of an underwriter. Because so many of these programs, especially if you start talking about down payment assistance programs, they're great programs, but it adds to the complexity of the process. And this is something in many cases that you really want an underwriter's eyes on. So for instance, here we'll do what's called a conditional approval. And what that means is you have submitted your documents, and an underwriter, a human underwriter, has looked at your file, and we have issued you an approval letter, not just a pre-qualification. You are fully underwriting approved, subject to, the appraisal, line of work, your employment verification, those types of things. So you're farther along in the process, for starters, and you have a little more certainty about where you're going to end up as well.
Any tips for people that are, I don't want to throw you for a loop on this one, but any tips for people that are like self-employed or anything like that? I think if you have a W-2 type job and it's, kind of easier to validate someone's income that way. What if somebody is like self-employed? I think, back a few years ago, they made it kind of a little bit more difficult, I think, for people who are self-employed to get a mortgage. How does that work now? Is there any difference there, or, just kind of allow for more time?
Yeah. When you're self-employed, it's important to remember that, under the whatever program we're talking about, under the guidelines, the underwriting guidelines, and when we talk like those agencies that we were talking about, Fannie Mae, Freddie Mac, FHA, which is HUD, USDA, VA, whoever, they set the guidelines for all these programs, and they're going to be the same from lender to lender. When you talk about self-employed, like we as lenders are required to verify your income. And if you're a self-employed person, the only way to do that is really with your tax returns.
Okay.
So if you have a situation where your income is not reflected on your tax returns, or, if you're writing a lot of your income off, then only the income that is reflected on the tax return is going to be able to be used for qualifying. So, which might be fine, but it's important to know that is what the lender is going to look at. The other thing I would say too, and I can't remember if we talked about this last year, but there are some new requirements because of these were implemented last year because of COVID and all the shutdowns and everything. And I don't know, like right now, we're still using these guidelines. I don't know if they're going to go away anytime soon or ever. But for conventional loans, you now have to provide a profit and loss statement, an updated profit and loss statement up to the month before you applied. And that, again, that was put into place last year when so many businesses were shut down. That's basically to be able to document for the lender that you are still, your business is open and operating, and, you know, there's still revenue coming in. So be prepared for that as well. It doesn't have to be, you know, a CPA prepared. I mean, all it has to do is just list, this is what your income, you know, your revenue was, this is your expenses for the first however many months, is what your net income is. It's, you know, and then you do have to typically, again, this could change, but you have to provide some bank statements as well to show, you know, the revenue still coming in.
Gotcha.
So it's a little more involved.
So, and the reason I bring it up is that I think a lot of times people will like decide, hey, I want to go look at houses or I want to go see stuff. And then the market is so competitive where like a lot of the times people will look at a house and there's maybe 5 people interested in the same house. If somebody's got to wait, you know, for, you know, 3 or 4 days or whatever to kind of go through the pre-approval process, by the time they get their letter, they're probably already going to have missed out on that house. And so it's super important, I think, to try and get that process started early, no matter what, because you just don't want to miss out on that perfect house when it comes out, or feel like you're constantly missing out. Like if you missed out on one and that was like that one house and everything gets compared to it and you looked at it, you know, you kind of can never get that back. And, you know, like, oh, if I only had gotten that one, whereas if you didn't look at it, you wouldn't have known it was there. But anyway, so it's just something that I always recommend to people. It's super, super important to get that lending process started early so that you've got that taken care of and you know, you can kind of really get started with it.
Yeah, absolutely. And that kind of goes back to that upfront underwriting that I was talking about as well, especially for self-employed. You know, that is really important because I can do an analysis on your income up front, but I'm not the underwriter. So lots of times the underwriter is going to, you know, they or whatever. I don't calculate things exactly like the underwriter calculates it. So you want to have that done, income analysis all done and everything up front so that you know you're good to go. And then you're ready to, because you know, that way you know what your price range is, you know what you're looking for, you're ready to roll as far as finding a property.
All right. So speaking of finding properties, you know, it seems like the houses that are selling the most, you know, the quickest and for the most money, the ones that are really move-in ready and that sort of thing. What if somebody finds that, you know, maybe there's a little bit, you know, maybe they find a fixer-upper or something that needs some work or whatever. Are there any loans available to people? Like, let's say they buy a house and, you know, it needs a lot of renovations, but they don't necessarily have the money to do the renovations right up front. Are there loans to help people with that?
Yeah, absolutely. And I'm glad you brought that up because there are renovation loan programs available, and they are, in my opinion, I think they're very underused. But there are both conventional renovation programs. There's a very popular one through FHA. It's called a 203K. Trying to think. I think VA has also rolled out a renovation program. So the cool thing about it is, let's say you find the house that you're interested in. It's in the location you want, square footage is right and all that stuff, but it hasn't been updated in a long time. So maybe it's going to take $30,000 to update the home, whatever, you know, flooring, paint, and you don't have $30,000 in cash, or maybe you don't want to drop $30,000 in cash after you already bought the home, in addition to your down payment. So the good thing is your down payment is going to be based on the total project. So let's say you're going to buy the house for $250, it needed $30 of work, and you were going to do a 5% down payment. So now your 5% down payment is 5% of the 250 plus the 30, that's 280, whatever that would be, 5% of 280, instead of 5% of 250 plus another 30. to do the renovation.
Okay.
So it works really well. It is important to note you've got to have a licensed contractor doing the work. So you're not able to take the cash and do the work yourself or anything like that. You do have to have a contractor involved.
Even if you
But
are a contractor,
it allows you to
what if you're a contractor?
say,
will they let you do that or okay?
No, you can't do your own work.
Right.
Unfortunately, that's
fine.
Again, this stuff changes all the time, but that's the way it is right now. You cannot do your own work, even if you're a licensed contractor. Also, you can't be related to the contractor. So you can't have your brother that's a contractor do it either.
I mean, I guess it makes sense.
Yeah. So it's, it allows you can go ahead and buy the house. And in that scenario, the $30,000 is set aside into an escrow account and it's released to the contractor as the work gets done. And there are guidelines as far as how long they can take to do the work and that sort of thing. And there's a vetting process that the contractor goes through as well. But it's a great program because, if there's something that needs to be done, you don't have to spend tens of thousands of dollars up front getting the home in the condition that you want it to be in. Your only down payment is based on the total project cost, including the purchase price of the home.
Okay. No, that's really good. And I'm surprised that I don't see more of them, because there are some houses out there that I think maybe would sell if people realized that these programs were available. And so anyway, is there any limit on the dollar amount for repairs on those properties? Just out of curiosity, I mean, like, is there a percentage of the deal or something?
There is somewhere, but it's pretty healthy. I can tell you that. What I can tell you is that I don't know the exact dollar amount, but I know that, like, if on all these programs, I think this is a state of North Carolina thing, but once you get up to about $30,000 in cost, you can do like up to that amount, and it's called a limited renovation loan, as long as it's below that dollar amount and you're not doing anything structural. If you get past that dollar amount or you're doing anything structural, then it becomes a standard renovation loan. And not one is not better than the other. It's just that the limited is typically going to be more cosmetic stuff, and stuff that can be done fairly quickly, because it's got to be done in 90 days. If you get into the standard where you're starting to move around load bearing walls and stuff like that, obviously that's way more involved and a little bit more of a process and takes longer to complete as well.
Sure. All right. So what options, I guess another issue that I feel like people are having now is we have a lot of potential buyers. Our agents have lots of potential buyers that are like, I want to find the right house, but in order for me to buy the right house, I feel like I need to sell my house first. But then the problem with that is if they sell their house first, and there's nothing on the market, then they've sold their house and have nowhere to move. And I feel like it's something that's kind of like really like tightened up our whole market, where like it's made it really difficult for anything to happen. So what options do buyers have in that situation? Like, assuming that their income is good and, they're not heavily, debt leveraged in, other debts or whatever, what other programs or what other things can buyers do if they own their house, but basically don't want to sell their house until after, maybe after they buy the next one? What kind of options do they have?
Yeah, that's what I was going to say, is that's kind of where this goes, is you have to make the decision, or at least look at the possibility of, can I buy another home without having to sell this current home first? And what are the implications of that? Well, I mean, there really is two types of heartburn that everybody has around that. And the first one is, I'm going to have to make 2 mortgage payments. So you might be making 2 mortgage payments for a while, but if you think about it, well, first of all, let me just say, you have to be able to qualify for both mortgage payments. So that would be the thing. You have to have enough income to be able to qualify for both mortgage payments. But let's say you do, and you're going to buy the new home. And so when you close on your new home, you're not going to have a payment on that for, it depends on when you close. But let's say if you were closing today, it's July the 12th, your first payment would not come due until September 1st. If you put your home on the market, to sell it tomorrow, it's going to take 45 to 60 days, probably. So there might be, maybe there's a month, maybe there's 2 months, maybe there's 3 months where you have 2 mortgage payments. So, I mean, unless there's something, if your home is appropriately priced, it's going to move pretty quick, I would assume, in this market. You're more the expert on that.
That's the way it's been going. That's for sure.
Sure. So I think you have to get comfortable with the fact that, yes, there might be a couple of months, there are a few months where you're going to make 2 mortgage payments, but it's highly unlikely that you're going to get stuck making 2 mortgage payments for, a year. It would be a short-term thing. So that's the first thing, is you have to get comfortable with that. The second thing is, if you were going to sell your home and you're going to extract that equity and use that as a down payment on your new home, well, now you don't have that. So what you might have to do, unless you have a lot of cash sitting around, is you might have to make a smaller down payment on the new home. So I always counsel the clients that I work with, at least if they're interested in doing this, you can make a small down payment on the new home. And then when you sell your home and you have that cash equity from the new home, you can do a principal reduction payment on the new mortgage, and you can do something called a recast. Now, this only works on conventional loans. It won't work if you're doing any kind of government loans. But a recast simply means you go to your mortgage servicer, you do a principal reduction payment to pay the balance down to where it would have been had you sold your home first. You pay them a small fee, and they will recalculate your mortgage payments on the new balance. They'll re-amortize those mortgage payments, so you don't have to go through the whole refinance thing, all the closing costs and the appraisal and all that stuff again. So a lot of people don't realize that that's available, but that's something that you could do. I mean, again, all this is, it takes a few extra steps to make these things happen, but in the environment we're in, sometimes that's what's necessary.
That preparation is key, and that's I'll keep bringing that up. And when we counsel people for when it's time for them to either buy or sell, it's important to have these conversations and put them in touch with the right people so they can kind of make the best decision for them. But I mean, we've helped several people in the past few months, just in the situation, just like you discussed, and, got their house sold after the fact. And it was nice. I mean, a lot of the people appreciated the fact that, you didn't have to close on the exact same day, and you had a little bit of overlap and everything, because that can be a whole nother level of stress. I mean, and they say, some of the most stressful things to go through in life are marriage, divorce, and buying and selling a home. Sometimes all of those things happen at the same time. And, if you multiply that by 2, where you're buying and selling, and then you're going through a marriage, you're going through a divorce or something like that, there's a major life change event, that can be really, really stressful on people. So if you can kind of take it down a notch and eliminate one of those things, and just know that, you're going to be able to add that money to the down payment. Now, how does it work if somebody, let's say, let's say I only put 5% down on the mortgage instead of 20. How does that work from a PMI standpoint when they recast this? Do they get rid of the PMI then? Like, I might have PMI at the beginning and then it gets rid of it, or how does that work?
That's a good question. And again, I've been in this business a long time, but I'm still learning stuff. And the whole PMI thing, and dropping the PMI is something that really happens after the fact, obviously after the loan is closed. But that is something that just came up for one of my clients, I don't know, a couple of weeks ago. So dropping the PMI is different from recasting. That's another thing that you have to go to the servicer and request. Let's say you started out at 95%. Now you've paid it down. You're at whatever, 75%. You want to drop the PMI. You have to go to the servicer and request that they drop the PMI. You have to say, hey, I've paid this down. Now I'm below 80%. I want to get rid of this. They're going to make you do another appraisal, or they're going to do another appraisal just to make sure that the balance is still there. Because again, this is something I did not know, but I just learned it. If you don't do the appraisal, both Fannie Mae and Freddie Mac have a 2-year seasoning on the PMI. So you have to pay the PMI for 2 years regardless, unless you get the appraisal, which again, you're talking about a $400 or $500 cost to avoid that PMI. So it's well worth it, and it's just an extra step, but it is doable. And again, like we were just saying, I mean, you know, these are a few extra steps that you have to do, but it's not, there's nothing about any of this that's cost prohibitive, and it will help you, you know, kind of smooth things over and achieve what you're trying to do, which is get into your new home without selling the old one first.
Okay. All right. So getting into another thing with people having trouble finding the right house, we've noticed an uptick in people that are interested in maybe even building their own home. So if somebody decides to do that, what does that process look like? And, you know, do they need to buy the land first? Like how, like, what do you suggest for people if they're interested in building a house?
You can do it either way. You can buy the land first and then, you know, go through the construction loan process, or you can buy the land as part of the construction loan process. A construction loan is kind of like a regular mortgage, except amped up, I guess I would say. So if you kind of think about it, you know, the standard mortgage programs are the conventional Fannie Freddie, FHA, which is HUD, USDA, and VA. You're going to wind up in one of those programs when you get finished building the home. So a construction loan is simply a lending vehicle to get you from the point where there is no house to where there is a home that a permanent mortgage can be done on. Okay. So I always tell folks, like, when you're talking about these permanent mortgages, from lender to lender, you're not going to find really any variations because everybody's using the same playbook. Construction lending is a whole different thing. So you will find some differences. There are a lot of lenders who have just chosen not to be involved in the construction loan process because it is, I mean, from a lending and underwriting standpoint, it is a riskier type loan. I mean, I try to help people understand, you know, as a lender, we're lending on a piece of collateral that doesn't exist yet. You know, there's nothing there except for the land. So construction and generally on construction lending, your down payment might be a little bit more. So typically on a conventional, most lenders will do 90 to 95%. We'll actually go up to 95 on the conventional construction. But you know what? USDA now has a construction loan, and FHA also has a construction loan. So you can do a 3.5% down payment on FHA. You can technically do a 0 down payment on a USDA construction loan.
Wow.
But what I would want people to understand is that it is, you know, it's a little tighter process. You know, whatever the underwriting guidelines are for the normal programs, when you start talking about credit score requirements, debt to income, you know, reserves that you might need in the bank, all those things are going to be a little bit tighter on these construction loan programs. And another thing too is that you will need to know on a construction is you need to have a contingency reserve, a cash contingency reserve, even on the government program. So that means you've got some cash set aside. In most cases, the lender's going to hold that cash. And the reason for that is when you start building a house, you know, what if something comes up that puts the whole process sideways that nobody expected, and now it's going to cost you more money? Well, and if you don't have that if you don't have the money, you can't just have the process stop.
Yeah.
So that's what that contingency reserve is there for. It's there to cover cost overruns and anything unexpected that might come up in the process. If it doesn't get used, it just gets paid back on the loan, or, you know, but it's there to cover unexpected things that might come up during the process.
Gotcha. So what's one piece of advice you wished all home buyers had before starting a loan process?
I would say follow what your lender asks you to do, and follow it very closely. And what I mean by that is the document, and I'll be transparent. I've been doing this a long time. The mortgage process can be a little tedious. It can be a little cumbersome sometimes. I mean, there are pages of guidelines for lenders from the agencies, let's take Fannie Mae, for instance, that say, this is what we require. This is the documentation that we require in this situation. If it's a divorce or child support, or when we talk about bank statements and you've got a large deposit, here's what constitutes a large deposit. Here's the documentation that we need. So I guess the first thing I would say is look closely at what your lender is asking for. If they ask you for a pay stub, a screenshot of your direct deposit, that isn't going to work. If they ask you for a bank statement, a screenshot of your bank balance, that's not going to work. If you give a bank statement, you have to give the lender all the pages of the bank statement, even that page at the end that doesn't, where you balance it, it doesn't have anything on there, that if it's a numbered page, these agencies are going to require that be in the file. So that's the first thing, is be very precise. The guidelines are very precise. Follow everything that they tell you to do. And the second thing is you want to try to get your documentation to your lender as quickly as you possibly can in the process, because that gives the lender more time to review this stuff. Because lots of times, for instance, if you get a bank statement in, there's what's considered large deposits in there. A lot of people don't realize that. It's kind of like, if I've got the money to close in the bank, what difference does it make where it came from? It makes a big difference. So, that can trigger the need for more documentation. So the earlier you can get that documentation in, the better off you're going to be, because that gives the lender more time to review it, react, and see if there's additional documentation that might be required. So follow what the lender says, try to get it to them within 24 hours if you can, even in the beginning of the process. That's my best advice.
All right, good. I think that's really good advice. So kind of switching gears a little bit. What if somebody wanted to get into the mortgage business today? What would they need to do? Like, what's involved with becoming a mortgage banker?
Yeah, that's a good question too, because I don't know if you follow the demographics in your business, but I know I haven't looked at it this year, but we haven't had a lot of, I guess I would say, younger people coming into this business. Everybody's about my age. So we need some younger people. We need some younger people to come into the business. But, your best bet is to find a mortgage lender who maybe needs an assistant, or, that would be my advice, is where to start, is be an assistant to a mortgage lender or a junior. And most companies have a position called a junior mortgage banker, junior mortgage consultant, whatever, where you're working under an established mortgage lender, and you can kind of learn things from them. The other thing I would say too is, you really have to, it's a great job and I love what I do. It's not always the easiest thing, but you have to really want to try. You have to really want to help people, I guess I would say. And you have to walk them through this process, because that's one of the things that I try to remember is this is typically a huge, probably the largest purchase most families will ever make. It's the most money that they'll ever borrow. And, I want them to have all the information that you want to track. And this is a very stressful time in most cases. So you want to try to make it as stress-free as you possibly can. That's a long answer to a short question, but
is there any requirements like school, or is there classes that people have to take or anything like that?
It really depends on the institution. I know some institutions will look for someone that's got a 4-year degree. Some don't. There's not a requirement that you have to have a 4-year degree or anything like that. And as far as the licensing, it depends on who you work for. So if you go to work for a federally chartered bank, I think you have to go through a background check, but that's about it. You don't have to really be licensed or anything like that. If you go to work for an independent mortgage banker like I do, you do have to go through a state licensing exam. You have to pass that test. And then every year you do have to have a continuing education, just like you do for the realtor license.
Gotcha. Okay. Interesting. I just thought that, again, I just feel like it's one of those things where I talk a lot about when I interview agents and that sort of thing, about like what it's like to get your real estate license. And so, but I don't think I really broached the subject with anybody from a lender standpoint. And, with everything kind of going on in the world today, I feel like there's a lot of people maybe out there either considering a career change or, kind of changing circumstance or whatever, that I kind of, thought I'd throw it out there to kind of, see what, if maybe there's a listener out there that they've always wanted to do that and just didn't know how to get started or whatever. Maybe this would be their catalyst. So I appreciate you letting us know that.
Yeah, when I first started full-time in mortgage, it was just, I got an office and a phone and a desk, and which, I kind of knew my way around. I had been doing some lending, so I kind of understood it, but mortgage lending is really a different animal too. It's like I was saying earlier, it's very precise. And so there's not a lot of ambiguity, I guess I would say, unlike like the lending I was used to, where, we're kind of looking at things, the whole picture. Mortgage lending's much more on point as far as the guidelines go and everything. Anyway, so that's why I say it would be really great to start working with an established mortgage banker, because that way they can show you how it's done. And that way you start to learn too. Because a lot of this job, just like what you do, is also marketing. You do a lot of marketing, and you've got to find ways to connect with your clients.
Sure. Or
potential clients.
That's good. Is there anything that we didn't get to talk about that you wanted to get out there?
I don't think so. The only thing I would say is, I think you and I have talked about this, is that the lending programs for second homes and investment properties have changed a bunch this year. So be aware of that if you're trying to buy a rental house or a second home. A lot of stuff is changing in our industry right now. We're hoping that some of that is going to change back soon. So we'll see what happens. But just know the availability on those programs is a little bit diminished right now.
Okay. Interesting. And then, did you have any questions for me? We're in related industries, and, obviously I think it kind of goes hand in hand. So, a lot of times it's good to, ask if you have any questions of me, so, with me being in this side of the business that you think might be interesting.
I do. Yes, I do. I think we both went through 2008 and all the fallout from that. And so, this past year and a half has just been crazy with appreciation. And I'm starting to hear even agents say stuff like, we're going to have another crash. We're going to have all these foreclosures. It's going to be 2008 all over again. I know kind of what I'm thinking about that, but I'd be interested from your expert opinion. What are your thoughts on that?
Yeah, I'm not really seeing it. I think it's way different on my side of the transaction from what I'm seeing. And you can maybe back me up on this, but maybe you won't. I don't know. But back in 2005, 6, 7, let's say, I think it was the loan process was a lot different. And the things that people were forced to go through were not nearly as stringent as what they're going through now. And so I feel like the people who, maybe there's people in that time period that probably shouldn't have owned a house or shouldn't have bought a house for whatever reason. No blame. I'm not, but just in general, I'm just saying at that point, there were a lot of people that probably shouldn't have been in houses that weren't houses, just flat out. And I feel like this time around, I don't feel like that's the case. Like every single deal we go through, it's every person that gets a loan is scrutinized to such a great level, to your credit. We get through underwriting, and, you do everything in the beginning, and at the end, there's always somebody that comes up and wants to know where this money came from, where that money came from. And everything has to be sourced right. And if the person didn't get this form done within 72 hours and they couldn't close, and there's all these rules and regulations that I feel like protect against people from just getting loans because they can fog a mirror. And I'm not saying that that's necessarily what happened before, but it's a lot different now. So I think that's number one. Number two, at least in our market, yeah, prices have been escalating. They've been going up, but we're still just catching up to other parts of the state. I mean, Charlotte, Blowing Rock, Asheville, Raleigh, Durham, even Winston-Salem, like those markets have been on a really wild, they've been on a wild run for, probably since 2011 or 12. And we didn't really start increasing our pricing or anything really till, after 2008 happened, till like 14 or 15. And so I feel like a lot of other parts of the state got a much bigger head start than we did. And so now we're finally starting to catch up to kind of maybe, and we're still not there. I mean, it's still more expensive in Charlotte than it is here, and even Winston-Salem and other parts. But I feel like we are starting to catch up a little bit. And I think that's another thing that I think is different. I think the last time it was kind of all, kind of across the board. And, we still have taken a while to recover from that. So at least in our market, I don't see that happening. Our unemployment rate is still fairly low. And then our area is investing, like every city, like Hickory is investing in their downtown and making things better. Morganton is investing in their downtown. Newton, and I mean, amazing stuff going on in Newton with their downtown. Conover. Mm-hmm. I mean, so like everybody in our market, and Apple with all the stuff they're doing in Maiden, there's so much positive things happening here at this time that's all leading to where we are now. I just don't see it. Might there be some, there's a lot of talk. I don't know if you're on TikTok at all. I recommend you not go on it because it's a big waste of time. But there's like these like little, they give all these like little short clips. And I feel like since we're in the, we have a podcast and we're in real estate and trying to figure out what's the next marketing thing. But so I end up on there and like, there's these people that are like, oh, there's going to be a big housing crash and all this other stuff and all these people in forbearance. But like, we have less than 1 month's inventory on the market right now. Like, in a buyer's market, or in a seller's market is really anything less than, 4 or 5 months of inventory. If it's less than that, that means you're actually in a seller's market. And then if it's more than 6, then you talk about being in a buyer's market. Well, like back in 08, like when everything kind of fell apart back in 08, 9, 10, I mean, we had like a year's worth of inventory in the market when that happened. And so we had this sudden like, oh yeah, we're having a lending problem now and things are freezing up. And oh yeah, by the way, there's a ton of houses on the market already and the economy's not good and all these people lost their jobs. And so now even more houses came on the market. And so that was a lot to cycle through at that time period. Whereas now I kind of feel like if, people more than likely actually owe more on their house or owe less on their house than what they owe. Yeah. They owe less on their house than what it would sell for. So if they did have to sell because they were in forbearance and they had to sell it, chances are they could get out of it at least without having to go into foreclosure. Yeah, they might, not make as much money on it, or they might not have cash to go and do something else with it. But I think it's a little bit overblown. And I know I kind of took a short question and turned it into a little bit of a diatribe, but I do feel like it's different. I can't see the future. As long as interest rates, I think, hover, under 5 or so, I don't really see it changing. If we get a really big spike in interest rates or something geopolitical happens or whatever, like obviously that can change things in an instant. But if we're going to kind of bob along where we are now for the next 2 or 3 years, I don't know that it's going to change in that time period, at least. And then on top of that, and I'm sorry to keep going, but and on top of that, we haven't built houses for the last 10 years. I mean, there are people that have built, there's houses here and there or whatever, and there's some projects that are in the works and stuff that might help a little bit, but like we haven't replenished our housing supply for like 10 years, aside from some custom stuff here and there. And so the demand for housing is not going to diminish until we can at least kind of get up to that point. And I think we have at least 2, 3, 4 years before the market can even catch up with that. So I'm really bullish. I mean, it's probably my job to be bullish. So you can take that with a grain of salt. So, I mean, my life is based on housing, just like yours is from a different perspective, but I just don't see, I feel like it's completely different. But again, like something geopolitical or something like that could happen that maybe makes it different. And, but as it stands right now, I feel like we're still on a really good path, and hopefully people, will feel more and more confident to build in our area so that we can kind of help alleviate the supply. So
I agreed with everything that you said there. And, I think because when you go back to like you said, the 2004, 5, 6, 7, there were, I was in lending at that time, and we had programs. We used to call it a NINA, no income, no asset, no employment. So the lenders were not verifying any of that stuff. Could there be a fit? Anyway, I don't want to go down that rabbit hole with those programs, but they were available. And so I think you're right. I think what was happening is the industry itself was manufacturing home buyers by these programs. And ask anybody that's bought a home, the lending guidelines are not looser today. I can tell you that. They're probably stricter than ever. Yeah. And I think, right with you, I think we've got all this, this is real. This is real demand. It's not manufactured by loose lending guidelines this time.
Yeah. And I think the lower interest rates, I think, are helping. I don't want to diminish that. I think, like I said, I think that's one piece of the puzzle that I think has definitely helped keep the affordability, even with the prices going up. It's kind of maintained a level of affordability. So I do think if we had a spike there, like a really big spike, I'm not asking you to quote rates. Today is what, July 12th. Can you give kind of a ballpark on July 12th to 2021, kind of where the range of rates are? And I don't want you to have to quote, somebody say, hey, you said it was this or whatever on your podcast, right. But just a general range or whatever. I'm seeing, anywhere from, and again, I can't quote rates. Let me let you do that.
Yeah, you're right on. I would say, with good credit, if you're doing a conventional, you're going to be in the low 3s to 3-ish on a 30 fixed, somewhere in that range. All those, a lot of it just depends on what your credit score is, how much money you're putting down. There's 15 things probably that can affect rates. But as a whole, yeah, you're right. We're on the lower end of that. It's interesting you would say that. I actually was just watching an industry professional. This guy is a really respected voice in the mortgage lending community. He used to be head of the Mortgage Bankers Association, and his whole presentation was, he had some forecasts in there. Rates are forecasted to drift upward over the next couple of years, not like quickly, but gradually. But he was basically saying it's not going to affect demand. The pent-up demand is there. And, if you go from 3 to 5, it's not going to diminish that demand.
Yeah. No, I feel like that's the case as well. It may put a little bit of pressure on, again, everything's going to come out to, in the grand scheme of things, a monthly payment of what people can afford. But again, it's, I think we've played catch up. Might the progress of maybe increasing 10, 20% a year or something slow down? Probably, yeah. I think it's probably going to need to, but again, it's all going to be, it's all about the demand and kind of what's out there. So anyway, well, listen, Tim, I think we had a good discussion. I appreciate you being on today, and I think it was some really, really good information. And I appreciate you being on the show, and we'll regroup and talk again next year. Obviously, you and I will talk a lot in between, but we'll do one of these next year again, and kind of help keep everybody updated on what's going on in the mortgage world. But thank you again.
Always a pleasure. I appreciate you having me.
Thanks. Yep. Tim Kerley, Atlantic Bay Mortgage, right here in Hickory. If you need anything, I will leave his information in the show notes. And if anybody wants to reach out to Tim for their mortgage needs, feel free. And that's it. I'm going to sign off. Thanks, everybody, for being here today. And thanks again, Tim, for being on. Have a great day.
Thank you, Mike. All right. Have a good one, everybody.
All right, thanks.